Good morning. Okay, so I already see that we have some comments. How's everything going, man? You good? Hopefully you are indeed. Um, Let me see if I can turn the lights on because this thing is. Okay, much better now. Yeah, how's everything going? Yeah, nice to see you guys. Um, crazy volatility. What? Yeah, I'm working out, but I'm listening. Fantastic. That's it, man. That's it. Good to know that. Always working out. That's one of the most important things, actually, 'cause especially in the stock market. I would say because most of the time you do nothing, and people always try to come up with an excuse to actually take action, and so there are. I think working out really help us to to just stay away from everything because there are so many things that we can't control. So yeah, school is going well. So we have 65 members right now, and I built it based on the feedback that many of you guys shared with me, and it's interesting because many of you actually wanted the same thing. Many of you are clients. Some of you are just just members, subscribers to the YouTube channel, but you all had similar pain points, and so I just use that feedback to try to come up with good modules, and that's it, and to create more value. But cool, you are a school member. Okay, yeah, that's awesome. So yeah, I mean, I share. Yeah, of course you are. So I share a lot of info there about the research that I'm covering, and I think it's valuable. And you have access to a lot of resources that are free, and those are basically information that I pulled together from different sources, from different things that I'm subscribed to, like newsletters, research reports from major banks like JP Morgan and so forth, and I take action. So based on that information, I try to come up with certain investment decisions, but most of the time I do nothing, and that's it. Because there's a lot of research that goes before investing in a company. As you guys know, I don't invest in a company without having full conviction in it, and so it's very hard for me to leave a company to swap it out to another company unless something really bad happens. And I mean, and then you can argue, you can make the case that, oh yeah, but what's bad for you, it's not bad for me. Yeah, it's true. And but especially if you are investing in a company that is going through a turnaround period, right, like many of the companies that I own are, you will always see massive stuff. Typically they sack the CEOs, they are restructuring the business. But then what you have to understand is, okay, is this going to take more than 3 years? And if I think the answer is no, then I will stay invested. If I think it's a more structural issue, then yeah, I may consider selling the position. So yeah, I'm sorry about that. Sucked. PayPal. Look, PayPal. What can I say? Many people, as you know, sold at those levels, say $50 a share, even at $40 a share. I still think this company is going to be a very good investment. But look, it's what I keep telling you guys. If you bought shares at $100 a share, you're not going to see a good return on your investment. Okay, it's not going to happen, because even if you are right, so even if I'm right, and if I know that the company will eventually come back out of this, it may take longer than 3 to 4 years for that turnaround to play out, and for the stock to go above 100. I mean, based on current sentiment and current fundamentals, I think stuff will have to happen. All right. And the core issue that they are facing is still branded checkout experiences. I think it's going to take a while to turn that around. And that's what analysts are paying attention to until the other segments start contributing more to overall revenues. But yeah, when you have a cost basis around $60 a share, which is my case, I mean, I'm okay. I don't need a lot of things to go well for me to double my money in the next like 3 to 4 years. So I'm happy. Record free cash flow, record revenues, margins have been improving. If you look at margins over the last few quarters, in fact, ever since Alex Chris took over, but yeah, and so let's see. I think they have different levels to pull. Let's see what this guy does. I'm not fully convinced that this CEO is the right choice, but we will see. Same can we? How do you feel about Meta at 530? Yeah, I think the new PayPal CEO needs to stop the share buybacks and reinvesting, innovating. I mean, yeah, that's one thing. But when you do have this stock at these levels, look what he did at HP. Well, okay, this is exactly what he did at HP, and the stock ever since he stepped in. So once he started in the company, not a CEO, when he began at the company, one of the things that they did is they did a lot of buybacks, and the stock was trading in the right. It was trading at multi-year lows, and I think they took advantage of that. And if you had invested in HP around that time, you would have made a lot of money as well. Now, granted, if you stayed invested forever, then the stock eventually came back down, and you can see that since 2019, I think HP did nothing. I mean, yeah, but that's it. Do I want to own PayPal forever? I don't think so, right? I mean, that is not the base case for this company. A lot would have to go to a lot of things would have to go well for me to stay invested for longer. But I think you get an easy double for sure, double, maybe even triple in the next 3 to 4 years. So we will see. How do you feel about Meta at 530? Meta, I'm going to share. Yeah, I'm going to share my screen, guys, as I normally do. LVMH versus Hermes. What is your opinion? Great question. What do you think about Evolution AB ticker? Yeah, yes. So Evolution AB is part of the portfolio, so I'm well aware of that company. Okay, let's take one step. Let's take this one step at a time. Let me share my screen so you guys can see. Okay, so what we have here is, let's go here to the investing. Meta is a company that I'm eyeing together with other ones. Let me have a look. Meta got flushed, right? Massively. Yeah, look, the blue line is already drawn in the chart. Guys, you know me. So maybe some of you are new to the channel, so welcome. But the blue line right here marks the point at which I might be interested in maybe certainly doing more due diligence in the company. Look, I like Meta a lot. I mean, I think this is a great business. It is run by, in my opinion, a controversial yet brilliant CEO, a lot of skin in the game. I mean, they just tick all the boxes in terms of quality. And I think they have a huge moat, very difficult. However, what you see with Meta, if you go back to ever since they became a publicly traded, right, you can see that they go through these periodical crashes. They do crash a lot every now and then because, and now we are seeing more of the same thing. So I have no rush right here. Based on my intrinsic value assessment of this business, I would be comfortable starting potentially a position at 384. It's not set in stone, by the way, because I run a concentrated portfolio of no more than 8 companies. I'm not going to add more companies to the Like a Tortoise portfolio. I have 7 companies in that portfolio. There is room for one more. So for me to buy Meta and another one, I would have to sell one, and I'm not lean on that. I'm not leaning on that for the time being. But yeah, I mean, it's a great company, so we will see. In terms of Hermes, I own LVMH, as many of you may know, and LVMH, no, MC. This is the ticker symbol. Yes, wait, LVMH. Doesn't really matter, does it? Yeah. Okay, so LVMH, let me show you this right here because it's easier. LVMH. I want you guys to see the chart. This is what I bought the company, okay? So I started the position right here around 427, okay? So I started this position in June 2025. Look, did I know this was going to be a bottom? I don't make decisions based on technical analysis. So based on my understanding, I had a huge margin of safety around these levels, 50% always, which means my intrinsic value was much higher than that, of course. And in addition, it coincided with this level of strong support that you can see right here. And then the stock took off, and now it came crashing down. The reason for that is because number one, they generate 50% of their revenues in the United States and China, and due to tariffs, then they got hit. However, what do you want me to say? I mean, consumer discretionary is also struggling, so this is not unique to LVMH. You guys look at the consumer. I show you this guys right here. I'm not sure if you took the opportunity to see my last video, but let me have a look. Market concentration versus valuation. I think that's here. Take a look at this. Look, fund managers. Okay, so what fund managers are underweight consumer discretionary the most since December 2022. What that means is you can see a lot of opportunities in this space right here. You know, look where you were back in 2008, 2009. Okay, so I see a lot of opportunities. Now look, LVMH falls into that category. Understandably, it's gonna get destroyed in this like during this cycle, and you can see that with other companies. For example, look at Nike. Nike is getting absolutely hammered. All right, same thing with Lululemon. Lululemon also getting absolutely crushed. And if you go check Deckers, look, another company. All these companies that sell discretionary items are all getting smoked. So what you guys should do, right, is make a watch list of these companies and think and start doing some analysis on them. Maybe you already buying their products, in which case that meets your meaning criteria. So right, so you already buy the products, you like the company, that is a good starting point there. And then you try to understand what the competitive advantages are and whether the problem is structural or if it's something that is cyclical. It has to do with the current state of the economy. And I can tell you right now that many of the things bringing these companies down are not structural, they are tied to macro factors. So yeah, if you are going to choose between Hermes and LVMH, my humble opinion is that I would buy LVMH every single day because number one, they are the largest luxury empire in the world. Okay, in fact, it's interesting that you mentioned that because if I go here to mode trades, I even have LVMH Empire right here, as if I was already prepared for your question. I wasn't, but look at this. I mean, this is incredible. Okay, I mean, this is absolutely staggering. When I started delving deeper into this company, I had no idea they owned all of these brands, which makes them moat even more incredible, right? So no, they are not going to go anywhere. In addition, if you go right here to stock and lock, and if you go to insiders, you can see that 50% of the company. What is this thing? Yeah, look at this. You can see that almost 50% of this company is owned by the family. Okay, so we are talking about a company with a lot of skin in the game, and this is exactly what you should. I mean, what interests you. I think Hermes is also a family-owned company, granted, but the valuation compared to LVMH, I mean, I think LVMH is much more attractive at these levels. So I hope that helps. I think the new PayPal, okay. So I think I already discussed that one. Okay, Evolution AB. Evolution AB. I was discussing this with a subscriber to our YouTube channel not long ago. Look, Evolution AB. So the problem that we have here, they cut the dividend recently, as you guys know. Evolution AB. Is this a red flag, the cut of the dividend? There are many reasons why companies can cut their dividends. One of them, and probably the one that should concern us most as long-term investors, is financial constraints. That is not the case of Evolution AB because they have staggering margins. They are very profitable. So this is not a company that had to cut the dividend because they were struggling financially. In fact, if I show you right here the margins, this is staggering. All right, I mean staggering. They continue to boost some of the most incredible margins I have ever seen, like ever, basically. Even though they've come down for sure, they continue to be staggering. You can see that on a quarterly basis, net margin is actually increasing, which is something that I like to see. And in addition, so if you look at the free cash flow margins, it's come down because of heavy investments that they are doing. But this is very, very attractive, as you can see. If I change this to the trailing 12 months, look at this. So the average since 2014, this 37, they are at about 52%. This is staggering, okay? So that is not the problem. So why exactly did they decide to cut the dividend once given that it's common policy in Sweden for companies to share 50% of the profits with shareholders? The reason is they are either going to buy back more shares, which I think is a positive, or they will probably do more reinvestments back into the business. And that can come, I don't know, maybe open new studios all over the world, right? Or perhaps doing some acquisitions. I don't know. One of you brought to my attention, and it can happen. Maybe are they pondering going private? And I have a hard time believing that. If that is the case, then I think they will be screwing shareholders. It can happen, but I don't think they're going to do that, because if you read what they put out recently when they decided that they were going to cut the dividend, they actually mentioned that the dividend is not the best way to return value to shareholders based on their assessment. I'm not what they don't mention is that whether they are considering shareholders by and large, or just a few handful of them. Okay, so for example, this guy Dart Kennett, he owns 23% of the stock. Is he considering taking the company private? I have no idea, but again, my cost basis is quite low, and so I do hope that they don't frame me and other shareholders alike. The beauty about buying stuff with huge margins of safety is that if they do end up going public, and if you bought, say, 1,500 SEK for this business, you are probably now hoping and praying for the business not to go private, because if it goes private, they're not going to pay that. In my opinion, I mean, you're not going to get your money back. That's just my opinion. So my cost basis on this is around 730, something like that. So it's quite low already, because I bought with a huge margin of safety. But I don't think that will be the case, guys. But like I said, I don't have a crystal ball, and this management team is not famous for communicating things to shareholders very openly and transparently, which is not something that I like. But again, when you see this type of business with just such a huge margin of safety and so much, they have so many growth opportunities in the future. No competition comes closer to matching their scale. The problem that they are facing is regulation, and I don't think that is. I don't think regulation is structural. I think it's temporary. But granted, it's been taking a while. It's been several quarters right now. So let's see what's going to happen this year, but you have to be patient as well. Remember, companies operate in a dynamic environment. The problem here is what they decide to do with the dividend. I'm curious as well. Okay, the screen is black. Wait, you don't share the screen. What? Don't you see the screen? The screen is black. I would like you to have a look. Did you manage to see my screen when I was sharing? Now we can see the shared screen. Okay, I think you managed to see that, right? Okay, so let me see what you guys are saying, screen. It's okay. Okay, awesome. I can see it now. Cool. You don't. The screen is black. To have a look at I think someone, the first one. So you guys asked me to analyze ResMed. ResMed. I think. Okay, let me share my screen. You should be seeing it now. Let's have a look. ResMed. Okay, so what do these guys do? Develop. Okay, they are in the healthcare sector. I mean, look, the healthcare sector has been left for that as well. I was even sharing this with a client the other day. I think if you guys have an edge here, you can make a lot of money in healthcare, in my opinion. I'm going to show you what I mean. I share this on YouTube as well. You can see. Where is this? Equity. Yeah, look at this. University of Michigan consumer sentiment left for that. Look at that. Consumers are really struggling with inflation and they are so negative on the economy. It makes sense for consumer discretionary companies to be under pressure because they are curtailing spending. However, this is part of the business cycle, and sooner or later, so you don't want to be a seller because look what happened around these lows. Okay, so yeah, but I wanted to show you healthcare. Yes, look at this. This is healthcare price index. Let me close these ones. This is, and I believe you guys are seeing thousands of screens. Can you wait? Hold. If I show you this, I think you can you see stock analysis? You should be able to see that. I wanted to. Yeah, I want you guys to see different screens because I'm sharing like I'm sharing different images, but I'm sharing my entire screen. So you guys, I have many windows open, but you should be seeing like right now, for example, the healthcare index price relative to S&P 500. Yeah. So what? Ah, well, you can see. Awesome. Thank you so much for letting me know, mate. Okay, so let me go back right here. Okay, so yes, you can see that healthcare is fleshed out in 2025. This still proceeds in 26, and I think you have a lot of opportunities in this space. I told you before that some of my clients bought Novo Nordisk, and I have no problems whatsoever with Novo Nordisk. If you bought them with a big margin of safety, I think it's going to be very hard for you to lose money on this company because they have a moat, guys. I mean, it's just in price is what you pay, value is what you get. People that bought this thing at 125 are also praying. Yeah, I mean, probably I certainly would have sold that by now because of opportunity costs. But if you bought it with a huge margin of safety, they operate in a duopoly together with Eli Lilly. They have big moat. They're not going to go anywhere. They just have to adjust to the current market headwinds. and I think they will do that. In the meantime, you are collecting an attractive yield that is at or slightly above inflation, certainly here in UK. All right. But so there are other opportunities. And so the one that you asked me to analyze, ResMed, this one is you are still paying a higher multiple compared to a company like Novo. But what exactly do they do? Develops, manufactures, and markets the medical devices and cloud-based software applications to diagnose. Yes, so the first thing you have to do is software applications, cloud-based software. So this is also in that space, in that category, software category, which is probably why this company is facing some selling pressure. Analysts rated a buy, which is good. I mean, understand why AI cannot disintermediate at least part of that part of the business, right? I have no edge as far as healthcare is concerned. I find it extremely boring. I'm not interested in this stuff, but and that's why I haven't added a single one to the portfolio. But right off the bat, what I can see right here is that they have a high score on stock and lock, which is good, 4.15. So they score high across different things like profitability management. Yeah, look, profitability management, growth, financial health, dividends, analysts. So very good. I like to see that. Let's have a look at the financials right here, starting with the income statement. Revenue since 2014. Look how nice this has been going up. Very good, 11% compounded. Nothing to complain about this. Earnings very solid as well. I like to see that. What about earnings per share? Okay, so they haven't been doing any dilution. Exactly. Only 1.44% change since 2014. But this is good, man. This is solid. What else do we see? In addition, if I go here to statistics tab, they probably have a net cash position. Here we go. Net cash position. So the balance sheet is pristine. The financial position is solid. Look, debt to free cash flow only or below one, so they can pay down all the debt within less than 1 year of free cash flows. I like to see that. So return great margins as well. Yeah, look. So from a financial, what are the insiders doing? Are they buying this thing or what? Insider transactions. Okay, I see a lot of selling here. I see a lot of selling here. I don't like to see this, as you know. I don't like to see. There are many reasons why insiders can sell, but when you see a wave of selling like this, and from different people, right? Look, this guy Farrell, then you have the CEO, then you have this guy, then you have so the CFO and the founder and chairman are selling a lot, and this goes back to late 2025 as well. I don't really like to see that. How much money do they have tied into? How much money do they have in the business? Let me have a look. Ownership. All right, so the chairman of the board still has $99 million worth of stock. The CFO, 17 million. What's the market cap of this thing? About 32 billion. That's a lot of money, though, that they have locked in. Yes, so the free cash flow yields, do they pay dividends? The dividend yield is quite low, but they have been growing the dividend nicely over time, which I like to see. And the payout ratio is still very low, so a lot of room for growth. I mean, from a financial standpoint, this thing looks solid. So they are try to understand why exactly this thing is going down. Probably it has to do with some AI concerns, because that's part of what they do as well. But also because they got clobbered together with the whole healthcare sector. And yeah, so if you are convinced about the moat, then I mean, I think you can make money. From a valuation standpoint, let's have a look at one more thing. On a relative basis, the net income is quite. Let me have a look at their net income versus free cash flow to understand which is the best metric. I assume they are converting most of their earnings into cash flows, but we are about to find out. Let me have a look. So a net income around one, this is good, 1 billion and a half. Free cash flows, yes, exactly. So they generate more free cash flows than net income, but net income is more stable. Net income is more stable. Let's have a look at net income over history. If we take the price to earnings, where is this valuation price to earnings? Okay, so let's flip that to the yearly chart to zoom out noise. So the latest is around 2027 with the medium at 34. So you are trading below average. And what's the forward PE? The forward PE is around 18, much significantly lower. So analysts are probably constructive on the company as well. They are projecting earnings per share growth of about 11% over the next 5 years, which is good. I mean, yeah, from a financial standpoint, I like it, and I think you are paying. It's a good business. Maybe when did they IPO'd? 1995. So this thing has been a very good compounder. Yeah, this has been a phenomenal compounder. So they are a very high quality business. It so appears at a reasonable price. They are not cheap, right? They are a high quality company at a reasonable price. This is a company that would probably meet the criteria for a core quality investor, which I'm not. And so, yeah, it works do more due diligence for sure. Okay. Um, I would like you to have a look at AVGO. AVGO, that's Broadcom. Broadcom is all over the place, all over the news for sure. Broadcom. AVGO, is it this? Yeah, I mean, so I know this company 2009. What do they do? Semiconductor. I mean, mate, the problem with this, so analysts rated a strong buy with a 43% plus upside potential, which is good. The PE is at almost 60. The forward PE is 22. Let me have a look at this. The problem with this thing is that everybody knows that it's great, and you can see looking at the chart price in and of itself tells you nothing about the fundamentals of the business, because the business, for example, can be trading at all-time highs and yet the stock being cheap. But still, based on my experience, you don't see. I mean, this thing went absolutely insane. Let's have a look at statistics. The yields are quite low, as you can see. So this is not cheap, definitely not cheap. The shareholder yield, not really attractive. They do pay the dividend per share, payout ratio. Yeah, but let's have a look at the fundamentals. And I'm pretty sure everything is great. They actually have a negative cash position, but they generate, right. So let's start with the balance sheet. Excuse me, with the income statement. So total revenues exploding, 30% since 2013, which is good. What about operating income? Exploding as well at a faster rate, which is exactly what you would want to see. Earnings are quite bumpy, makes sense, because this is probably not the right metric for us to use. We'll probably have to settle. We'll probably have to go with free cash flows. Let me have a look at free cash flows right now. Exactly. So don't use earnings to analyze this company. One of the things that I suggest, guys, always compare earnings with free cash flows, because sometimes free cash flows are very low relative to earnings, but over time they should correlate. Okay. But that said, companies that go through to a capex period can have low free cash flows. So if you are valuing them based on free cash flows, you are actually understating. You are punishing the company for no reason, right? Because the idea here is that over time, those investments will translate into profits. So in this case, definitely free cash flow is the better metric because of the business model of the business. And look, I mean, 39.71% since 2013, which is staggering. Let's have a look at the relative, let's have a look at the price to free cash flows right here. Look, it's very high. I mean, I don't like this. I really don't like that. So what I see right here is I see a company, and I know them because they are all over the news. And I see a company that is phenomenal, right? The financials look staggering, but the price is the stock is already priced for perfection, if you ask me. And so if I go and I'll show you something, statistics are projecting, take a look at this, 37.83% growth over the next 5 years. Now, what I want to say is if we do have a recession, we are not in the business of predicting what the market will do, but if we go through a slowdown, mate, the company is not going to go down 10%. It's going to go down 50, 60, 70%. And if you bought the company at these valuations, then you are playing with fire, in my opinion. Okay. So you don't really have a margin of safety. It's a high quality business at a high price, if you ask me. So the PEG, for example, if you analyze it on a PEG ratio, you will say, oh, Ed, but look, I mean, this is so cheap. The PEG is under 1. Guys, but that is assuming that they can actually achieve this crazy exuberant growth assumptions. And if they miss by a penny, that's what I mean. You don't have a margin of safety built into this thing. And so, yeah, that's just my take on it. Okay. So I hope that is clear. But yeah, the business is very good. Growth. What else do we have? Yeah, so you say forward P in the 30, project 66% growth. Yeah, that's it. So the projections, what you have to understand is, are you okay? Do you think that those exceptions are conservative? What happens if the company doesn't deliver on that 66% growth for 2026? Because that is too crazy, if you ask me. You have no margin of safety built into those assumptions, and so if you own a portfolio that is diversified, say, I mean, in my opinion, a 20 stock portfolio is already diversified, then Broadcom can have a place in it. But if you only have something, if you only have 8 to 10 companies in your portfolio, then no, I mean, it's not the company, a company that I own, because I think you can get better opportunities in the market right now. Right, thousands. Which are top 5 buys in the moment according to you? Because Baba stock may be deleted from Wall Street because of the war, oil control of US. Don't you afraid on your position? It could be like Russian stocks. I don't think that is going to happen. And to be fair, this has been the part of the bear case since the stock started trading at $54 a share. In fact, part of the reasons that caused Baba to trade around those levels, 54, when I bought it, it was near book value. I mean, which is staggering. And the reason was because of these fears of unlisting fears, right? Delisting fears, sorry. And I don't think that's going to happen, because if that happens, you will see a lot of money just being evaporated from a lot of these billionaires in US are going to lose a lot of money. Okay. Because if you're going to delist Alibaba, you would have to delist all Chinese stocks, if you ask me. And I don't think that's going to happen, because the exposure to companies like to Chinese companies is much higher compared to exposure to Russian stocks at the time. You can't even compare, right? I mean, it's just not going to happen. And think about the repercussions. Think about what China could do as a result, because yes, the United States remain the number one global power. But remember that the reason they are number one global power is because of Chinese products, and the Chinese can hurt the Chinese can hurt the United States a lot if they want to as well. And I don't think the administration wants that, in my opinion. So I don't think we will see that. I think those fears are overblown, and that's what I bought Alibaba, and so far it's been working nicely. And now, of course, you can see all these major banks, as they typically do, they follow the herd. So if the stock is going up, they are putting optimistic price projections, and now they have price targets around $200 a share for Alibaba. And I'm not selling a single share because it hasn't reached my intrinsic value, and that's it. So no, I have no fears there. Now, okay, which are top five buys in the moment according to you? So there are many companies that I would consider buying at these levels. I have to protect as well some of my clients, of course, because I share these names with them. But there are many opportunities in the market right now, and one of them, for example, some of these companies that we just discussed, guys. I mean, for example, look, LVMH is one of them. If you ask me, I would buy LVMH at these levels every single day. I repeat, every single day. Okay, that's just me. The largest conglomerate empire in the world. They have a huge moat. They have a diversified revenue stream. They are not going to go anywhere. They make decisions with the long term with shareholders at heart. And this is a great buy if you ask me. Not financial advice, as always. Do your own due diligence. But That's just one company. And another company, for example, is Lululemon. I mean, this is another company that I'm bullish on. They have been going through, they are part of the turnaround. So they are also a turnaround play. But I think they are taking steps to position the company, to start the company, restart the company on the right foot going forward in right foot going forward. So I don't think they're going to go anywhere. And they boost the best margins in their sector, even though tariffs have significantly hurt their margins. And that is the power of boosting attractive margins, is that when things like this happen, like tariffs, you can afford to absorb a lot of these cost pressures while still remaining competitive. And that is the case of Lulu. And so that's another company. In addition, if you guys have any edge in software, I don't. Okay, I wanna be clear on that. But I know very good, great investors that have bought, for example, Adobe. I'm not going to do that. I'm not convinced about its moat, but you can see that I've already looked at the fundamentals and they are improving, as a matter of fact. So the company is trading at multi-year lows. The stock is so cheap, and all of that against the backdrop of improving fundamentals. So if you are convinced that AI is not going to disrupt it, you may have an interesting, a very lucrative investment into the years ahead right here. And last but not least, another company that we can discuss, and another one that is been on my radar, is Microsoft. And this is I love this stuff. I really live and breathe the markets, and I hope I can continue to do this for as many years as possible and create as much value as possible, because that really makes my days. But I'm so happy and I'm so fortunate not to suffer from fear of missing out. I remember putting a video on Microsoft when they were trading at $480 a share, with a price target around 300, which you can still see right here marked as blue on this chart. And the messages that I got were, "You are crazy. Microsoft down to those levels. I mean, you are absolutely insane." That is never going to happen. They have a huge moat. And guys, some of you may be new to the channel, but many of you guys asking me to analyze these businesses have been with me for a while, and you know that my philosophy is very different from most of the people that I know, because I tell you that no matter how great the company is, they go through periods of uncertainty, and you can absolutely buy them with a big margin of safety if you are patient. I don't care if it's Meta, if it's Microsoft, if it's Amazon. The best companies in the world go through these periods. And where are we right now? At $356 a share, all the way from right here when I started putting out that video at 480, and now here we are. So what do you want me to say? Do I think Microsoft is going to go back to make new all-time highs and reclaim that premium multiple that they were trading at? Yes. But again, to me, that is not how you make a sound investment decision. Because for Microsoft to go back to a PE above 35, a lot of things have to go well for the company. And so it can be that if you have, I mean, take a look at this. Look what happened to Microsoft. Where do I have that? This is stocks performance. Where do I have that? That is so cool. I was discussing that with someone not that long ago. Market concentration. It must be in here. Take a look at this. You have to take this into account. Absolutely. This should be part of your due diligence. So look what happened. Microsoft, right here at the peak of the 2000 bubble, it was a great company, even despite the stock crashing some 70% from its all-time highs. In doing nothing for 16 years, the company was fabulous. Okay, so the fundamentals kept improving all the while. Okay. So why didn't the stock go back to break even for 16 years? The reason is because of the multiple that we were paying back then. Now, granted, the multiple right now is not as high as it was back here, but you get my point. Price is what you pay, value is what you get. So wait, be patient, because they go through these periods, and now look where we are, already at 356. It's not every day that you see Microsoft down some almost 40%. Okay, and I think, look, will it go back down to 300? I have no idea. If it doesn't, it doesn't. I'm not going to cry, because that's just my investment philosophy. And I know these things because I've seen them multiple times, and I've shared them with you here in the charts. For example, with Meta, that crashed 75% 3 years ago or so. Netflix, that crashed 75% 4 or 5 years ago. And those are the times you should be very interested. Okay, but anyway, sorry about the rant. So it's a great company, not at a very attractive price yet. So, but for those of you guys who are more aggressive, maybe you should definitely consider start doing due diligence on in this company, because I don't think they're going to go anywhere. I think they are a great company with a lot of skin in the game. What do you think about diversifying investments across different sectors? Is it absolutely necessary? In my case, I need to have sector diversification. I'm going to tell you why. Think about it this way. If you own 8 companies in the portfolio, or 10 companies, if can you imagine, so you are already very concentrated by all accounts. And so if you don't have some exposure to different sectors, if one of those sectors get clobbered, like consumer discretionary is right now, as you guys know, or healthcare, your portfolio performance is going to collapse, and you don't know when it's going to come back. Okay, so you want some sector exposure. And by the way, guys, I'm not immune to these shocks because I run a concentrated portfolio. The volatility that I see in the Leica Tortoise portfolio is far greater than the volatility experienced by more diversified investors, because I like to understand the companies that I own well, and I'm okay with that volatility. But many of you guys may not be in that position, in which case you should diversify for sure. I mean, across say 15 names. But yes, make sure that you have some sector diversification, like financials and healthcare, consumer discretionary. But don't just diversify for the sake of it. Always make sure again that you can understand the sector as well. And that's part of the reason why I'm not investing in healthcare, as you guys know, because I'm not interested in healthcare. Okay, I'm just not interested in healthcare. And so yeah, I have no edge in so no matter how great the company is, because I'm not interested, I won't buy it. Which ETFs have most potential at the moment, having in mind the sell-off? If you are considering an ETF, I would just settle for a low-cost ETF tracking. It depends on your investment horizon. Let's say you are in your 20s or 30s. I would just buy a low-cost ETF tracking the S&P 500 over time. That's it. Look, even if the S&P doesn't do nothing for the next 5 or 10 years, and that may very well happen. In fact, according to JP Morgan, chances are that you investors buying at valuations as high as they have been stand to generate zero returns over the next 5 years. Okay, zero returns. But if you are in your 20s, 30s, and if you have a very long investment horizon, buy a low cost ETF tracking the S&P, because chances are you will get your 9% annualized returns, and that's perfectly fine, man. Don't just if you don't want to go to be a stock picker and try to beat the market over time, just do that. Chances are that in 30, 40 years, the S&P will have averaged 9, 10% per year. That's it. Unless you are not constructive on the US economy, I think most economies, certainly in the developed world, will be in a better position in 30, 40 years. And I don't think the US is an exception. Okay. Oh, and by the way, in my girlfriend, she bought an ETF that only does dividends. I don't recall the name of the ETF. They are a dividend paying, so they only have dividend paying stocks. If you are only interested in dividends, that could be um, that could be um, that could be a possibility. But my suggestion is buy again low cost in the ETF tracking the S&P, and reinvest all of your dividends. Okay, because don't forget that over 30% of the S&P 500 returns over time is actually generated by dividends. Um, I have another one, Atkins Reals. Ticker, thank you for sending the ticker. That is very helpful. SNCAF. Oh, wait. Realis Group. Is this a realist? Is this a real? Industrials, engineering, and construction. With this cities provides professional services in project management and capital investment in the United Kingdom. Huh. In the United States, internationally it operates through 8 segments. Industrials. I think industrials are one of the. Let me have a look at this sector right here. What? You can be serious. What's going on here? No. Ah, okay. So the PE of this sector is around 32, and this company What's the market cap? So it's around 32. Uh, yeah, look at the. Okay, so Jesus Christ. What the hell happened here? The PE is only 5? Are you serious? What are analysts projecting? This is not even covered by analysts. Uh, at least not here. They don't even have a statistic they don't have the statistics tab right here. What? What the hell is happening here? So I have to go here. Hold on. Okay, so what do we have right off the bat? What can we see? Profitability 2.60, management 3.14, growth. Let me see the revenues and all of these things. If things are so different with industrials, because yeah, look, so yeah, and this is the problem, right? I mean, this is why I typically don't invest in these companies. Not to say that you cannot make a lot of money, for sure. I mean, you can, but it's just, for example, one of my criteria, right? I like to see revenues compounding at, say, 10% per year over the last several years. Now, look, since 2011, revenues have compounded by 3.1%. So, right off the bat, this will exclude this company from my investable universe. On a quarterly basis, revenues are going up, which is positive. Um, let's have a look at operating income. So they will look at these periods of right negative operating cash flows. I don't like that. And again, this happens because of the nature of the business itself. What about earnings? You see more of this stuff right here that I don't like. It makes everything a lot of it creates a lot of unpredictability. That's what I want you guys to understand. And unpredictability is the enemy of long-term investors. In addition, you can see that there was dilution right here. I typically don't like to see dilution, say at 10%. It's not egregious, all right? I want to make that clear. And it's nice to see that they have brought the share count down as of recently. But yeah, so what about the balance sheet? Let's have a look at the balance sheet. Uh, mm, for this, it's better if I just, yeah, they don't have, okay, so cash and cash equivalents, 1 billion, total cash, 1 billion and a half. I see total liabilities, current liabilities, 5 billion. Long-term debt is low relative to cash. What about book value? Flip this to the yearly. So book value is up. In fact, it's near all-time highs, which I like to see, right? So assets minus liabilities. I like that. What else do we have right here? Cash flow from operating activities. Yeah, I just don't like this. And a lot of that is because of net income. Stock-based compensation is exploding, as you can see. Granted, it declined on a quarterly basis. That I like to see. It really goes up right here. But is this cause for concern? Let's find out. I don't think so. Otherwise, there would be. Otherwise, stock and lock would flag that. So be aware when stock-based compensation is above, say, 10% of net income or something like that. But I mean, those are things that I don't like. But this is a cyclical business, mate, right? So as a cyclical business, you have to be very cautious, because if you don't get the cycle right, you can get clobbered because of the unpredictability, the underlying unpredictability of the sector. And so, yeah, I typically stay away from these very cyclical companies because of the unpredictability and inconsistency in the financial metrics. I hope that makes sense. And so, if I show you this right here, financial, let's have a look at the returns on capital. They will be bumpy as well. Yeah, you see what I mean? I don't like that. And it makes sense because of the nature. It was negative right here, now it's up. Here it was low. What about return on invested capital? Here it was low, up, then it was negative, and then it's up. And so I can't make sense of that, right? And typically I stay away from those things because they just go into my heart too hard pile. So yeah, I hope I helped. Do you think there's more opportunity? There is time asset sales. So you have to look at adjusted for core growth, sir. Okay, appreciate. Yeah. Okay. Good. Good. That's not. That's part of understanding the business, right? So right here, there is only so much that I can cover, but yeah, I mean, so spot on. That said, be aware of the cyclical nature of the industry. All right. So yeah, because like I said, you can make a lot of money in these companies, but if you get this cycle wrong, man, it's gonna be a terrible investment. I So do you think there is more opportunity in the equal weight like RAS versus cap weighted like SPY? Forward multiples are significantly lower. Yes, they are significantly lower. And the reason for that is because, well, again, they are not market cap weighted. What we are seeing right now is um, we see 7, 8 companies still generating the vast majority of the S&P 500 returns. And any when people say that, oh, I'm going to buy the S&P, a big chunk of that investment actually goes to these mega cap companies, right? I mean, so much for diversification. But nah, I think over time you will do well. You will do well. I think if you buy, I mean, the question you have to ask yourself is, am I okay with seeing no returns or muted returns over the next 5 to 10 years? If you have a long term investment horizon, I would just do what Buffett advises you to do, right? So, Buffett says he's a big proponent of index investing for people who don't want to understand what they own very well. And rightly so. I think, look, there have been recessions, World War One, World War Two, pandemics, and the S&P has averaged 9, 10% per year. Chances are it's going to continue to do that into the future. To V or EU recovery. In the last years, it was V fast recovery. Will I? Yeah, look, I'm going to tell you something. I'm not in the business of predicting what the market is going to do, but I'm telling you this. We are so, I mean, the markets cannot continue to go up all the time. It's not sustainable. It's not it's fake. Okay, it's fake. That's not the nature of the markets. And what happens is, ever since 2008, you see people buying the dip all the time, propelling stocks and valuations to multi-year lows. And I think we are well overdue for a recession. Okay, and I mean a serious recession. It's like 2008 2009 financial crisis type of recession. um, and it's going to be nasty. But think about all the malinvestments that have occurred over the last 16 years. A lot of these things need to go to zero. I mean, right? I mean, I show you guys this. We have companies in the Nasdaq that don't generate. Let me stop sharing this. We have companies on the Nasdaq that don't generate any money, not even, so they don't generate any revenues, let alone money profits, but they have been performing spectacularly well. In my opinion, this cannot go on forever. So it's going to end. It's going to be nasty, and it's going to create fabulous opportunities for us, patient investors, to plant the seeds, right? We are planting the seeds for the next cycle. Maybe the recession is not going to happen next week, right? I mean, I have no idea, like I said, but I think we are well overdue for a recession. And I think you guys know that it's been hard, especially for quality investors, because again, they pay high quality, they pay what they call fair values for high quality businesses, granted, but The problem is that a lot of those valuations have come down to reflect these risks, and then they get punished substantially. But because they own high quality businesses, chances are they will come out stronger. And the portfolio of Like a Tortoise is not immune to these shocks. In fact, we have been underperforming as well. But beautiful things happen when you have higher quality businesses based on our metrics, right? Based on margins, returns on capital, trading at lower valuation levels. But this here has been horrible for the portfolio. And I think we are all on the same boat here. But patient investors will thrive. You are expecting a crash like 2008. I don't know, man. I have no idea. I don't have a crystal ball. If it happens, it's gonna be nasty. But we are well overdue. I would say that there are so many malinvestments, a lot of people buying shiny objects, companies that don't generate any profits, like I said, because they see the neighbor getting rich. They don't do any due diligence. They buy companies because they see stocks going up on a weekly basis, and then the indices come down and they buy the dip because they know they have been conditioned to think that the markets always go up in the next few months. At one point, that is gonna stop, right? It's gonna stop, and then fear will turn into complacency, will turn into fear, panic, and I think companies that are phenomenal will actually consolidate during this period. They will buy competitors on the cheap, and they will come out stronger. That's just what I think it will happen. So if you own high quality businesses that produce real cash flows, right? Real cash flows, and if you buy with them with the margin of safety, you will do well, no matter the market environment. So I hope that's clear. Right, guys. So, oh man, I like this a lot. We will have the other one at the end of next month, and looking forward to seeing you guys there. Thank you so much for tuning in, as always. Some of you have been great contributors to the channel, and I do thank you for everything. And yeah, guys. I mean, thanks for. Yeah, absolutely. I mean, thank you so much for everything, for all the support, and let's see what happens next week, if the sell-off is going to continue, and if the situation in Iran comes to a quick resolution. I mean, I just, it's horrible for these victims, of course, but we will see what happens. Okay. Thank you, everyone. Enjoy your weekend. Hopefully, you'll smash it over the weekend. Try to rest, and looking forward to our next one. Thank you, guys.